Welcome back, everyone. This is Imran Razvi, or Raz, with Daniel Razvi, our tax attorney. We're with Higher Ground Financial Group, and this is riskfeesandtaxes.com.
Yes, riskfeestaxes.com. You go to our website and you can schedule a meeting with us to find out some fiduciary advice on your planning to reduce risk, fees, and
And this
taxes.
is all about retirement. So we're talking about really the time span, 5 years before you retire to the rest of your life. Because you only get to retire once, but we've retired hundreds of people. So we want to make sure that you do it right. So one of the things that we get asked a lot is, look, all your life you've been saving, working hard, saving money, putting in the market, and you have market risk, right? So what changes when you're close to retirement?
When you're close to retirement, hopefully you at some point have enough that you will be able to maintain an income for the rest of your life that's enough to live on. But most people assume that in order to get to that point, you have to take risk. And that is not always the case. You don't necessarily have to take risk to achieve the goals that you want to achieve. And you may already have won the game, as we've talked about before. If you already have enough saved, then there's really no reason to be taking risk. Most people do not know why they're in the market. They are in the market just because that's what everybody else does, or they think it'll it's the only way to grow the money. Well, okay, but why grow the money? Again, if you already have enough money,
But
let's
that's all I've done all my life is grow the money, put in the market, and close my eyes and hope for the best.
well, think about it this way. You have $2 million saved now, you're retiring, and or you're gonna retire soon. And maybe you have 2 more years left to work, but you already have enough. And let's say we've proven to you that you have enough to have more than you need in retirement, all the income you need with inflation and all of that, as long as you don't have a major market crash. So this money that you saved, it's enough to maintain all of your living expenses for the rest of your life, only if the market does not crash significantly before you retire.
So 2 years before retirement, I've got $2 million, and that's just enough to make sure I have enough income with inflation protection to be able to live comfortably for the rest of my life. But next year the market drops by 35%.
So now you got significantly less money. You got like 1.3 million now instead of 2 million, and now you're thinking, well, I got to work another 5 or 6 years.
Yeah, because 1.3 million does not work or compute to make the numbers work like they did at 2 million.
But if you already had enough money that your income would not decrease at all, you're going to increase your income in retirement.
Mm-hmm.
Would it really make that much of a difference if your 2 million goes to 2.5 or 3 million? Is that going to change your life? Are you going to now start spending a whole lot more? Most people would not. Most people are used to spending for a certain lifestyle, and unless you win the lottery or something and you go to $1 billion, you're really not going to change that much your spending. You might do a little bit of extra things here and there, but if you already know that you could retire with the amount of income that you need plus more and surplus for extra expenses and things like that, then having an extra half a million or $1 million is not going to really change your life. But what will change your life is if you have a major market crash before or early in retirement. So there really is no reason at all to take any market risk. Now, I'm not going to tell my clients to go ahead and take everything out of the market, right? There's always a chance that the market might have a really good year, and then you're going to be annoyed that you missed out on it. So it makes sense to have a little bit possibly in the market, but the majority of the money, you really don't want to have at a risk at all. I mean, even these days, interest rates are fairly high. So even in a bank, a CD, or an insurance policy, you're going to get some pretty good interest rates. So if you can get that with no chance of loss, and you already have enough that you can generate the income you need, there is no reason at all to take market risk.
But I like gambling. I like the feeling of playing in the market and risking my money.
Well, that's not me. I don't like gambling. But if that's you, then there are things you can do to still have that feeling, but with a little piece of your money. You still get the same thrill with just a small amount of money. You don't have to risk everything and then get a heart attack because the market actually dropped on you.
Yeah, in fact, you could be more risky. You take more risk and play a little harder if you know that your income is safe. And that's the key. Your income has to be safe in order for you to have that safety in retirement, the stress-free retirement. I mean, all your life you've been working and saving, working and saving. Most of our clients, they've been pathological savers. They've been saving and working hard, and that's why they've accumulated several $1 million, anywhere from a million to 10, 12, 15, 20 million. And they really don't have a desire to spend that much money. They've been very conservative. So that doesn't change very much. So what changes is you can't afford to lose that money in retirement, because now Just like it happened back in 2008. People remember that if somebody was retired, they had to go back to work because they lost half of their money.
So it's very, very important to reduce or eliminate risk if possible, market risk specifically, when you approach retirement or when you're early on in retirement, as much as you can. And I'm not talking about, oh, go buy bond funds. Those are less risky. Less risky is not no risk. In order for your plan to work, you need to have money in contract-based assets, not opinion-based assets. You don't want assets that the market opinion determines how much they're worth. You need assets that you can count on, that you know how much is going to be there, whether that's in the bank, whether that's in a treasury, whether that's in a annuity, whether it's in, there's a lot of different places you can have contractual assets that are not subject to market risk at all.
Just like your Social Security, it's a contract with the government. They're going to give you Social Security, and if they blow it all and they don't have money left, that's a different story. But the contract is they have a contract with you. They got to give you your Social Security or pension.
So there's a certainty you have there, which you do not have in any sort of market asset, even in dividend-paying stocks. I mean, dividend-paying stocks are great because you have those dividends, but the dividends are not guaranteed. You may or may not get a dividend next year, but you pick a good company. They've been paying a dividend for a long time. The value of that stock, though, is not predefined. So if you ever have a need to liquidate a large portion for some big expense, you may not be able to spend that the amount that you thought you had.
So again, back to the main question: why do you want to take market risk if you don't need to? What's the purpose? Just because everybody else is doing it is not a good enough reason. Just because you've been doing it all your life is not a good reason. You have to have a reason. What is the purpose of taking that market risk? Is it something that you're trying to get? If you're trying to get a certain amount of return, can you get it without having that market risk and risk losing some of your money, or can you not get it? If you can't get it, let's talk about that. But there should be a purpose to why you're taking the market risk.
Yes. So again, go to our website, riskfeestaxes.com, riskfeestaxes.com, and you can click the link and make an appointment with us. Make an appointment with us to schedule a Zoom call, and we'll be happy to talk to you one-on-one and give you fiduciary advice and help you determine why and what you want to be doing in retirement. So let's talk a little bit about fees as well, because we say risk, fees, and taxes. So we talk about risk. Let's talk about fees now.
So let's role play a little bit, Daniel. So I've got $500,000, and I want somebody to invest it for me, and I'm willing to pay a fee if it's reasonable, right? So I bring that $500,000 to you. So Daniel, what could you do for me?
Well, so you have $500,000, and let's say I'm going to earn a reasonable interest rate, about 5%. If you're listening here and you think 5% sounds pretty low, remember the S&P actually only did about 4.5% for the last 20 years, last 22 years. So that beats the market, basically. A 5% compounded return will beat the market.
Well, and also I'm pretty conservative, and I'm okay with 5%. But what is that 5% actually going to do over the next 25 years?
Well, that's going to earn $1.2 million in total growth.
So if I give you 500,000, you're going to give me. I'm going to grow by $1.2 million, and that sounds pretty reasonable. So what are you going to charge me for that?
Well, I'll charge you a 1% fee.
Is that normal? 1%?
That's about average. 1%. Yeah,
Okay.
That's reasonable. And in fact, I'm going to also charge you a fee every year, not just one time. I'm going to charge you a fee every year. 1%.
Well, I guess you're working every year. You might as well, right? You got to make a living.
Yeah. And I'm also going to charge you a fee on the money you had that I did not earn for you, the $500,000 every year.
Yeah, but you're making that money work for me, so that's good. Okay.
So
1% seems reasonable. What does 1% really mean?
So over the 25-year time frame, you end up paying $217,000 in fees. Wow. That's a huge amount of money.
So that 217 is not in my account anymore because it was supposed to be there, but now I've paid it to you.
Yeah. So then you lost the opportunity to earn interest on that money. So that's another $159,000. So on this asset that you are managing or having me manage for a 1% fee, you end up paying $376,000 in fees over 25 years.
So does that mean I don't get that 1.2 million anymore?
Right. If you put a dollar number on it, it sounds so much bigger, right? 1%. That's not much. 1.5%. Some people are paying 2% to their advisor. That's a huge amount of money when you actually calculate how many dollars of loss that is for you. You lost $376,000 out of 1.2 million of growth, which means 31% of your growth went away to fees.
Wow.
That's not a 1% fee. That's a 31% chunk out of your money.
Wow. And that's a normal fee. And 1% is not a high fee. I mean, we've seen people that are paying 1.5% or 1.8%. and some people are paying 0.75, 0.8%.
But you also have to consider, maybe your advisor is charging you 1%, but he has you in mutual funds, and the mutual funds are charging 0.5% or 0.75%, and maybe there's some cash drag and other things. So most of our clients, when we analyze their portfolios, we find that they're actually paying closer to 3 or 4% in fees rather than the 1% they thought they were.
That's crazy.
But even if you're paying only 1%, it has the potential to eat away almost a third of your growth over time. And that's a really big deal. And it's why we have it as one of our core philosophies to reduce risk, fees, and taxes.
And 45, 50 years ago, you really needed a broker to be able to buy and sell stocks. You don't need them anymore. There's so much information out there. You have the internet, you have investment newsletters and things like that. And ETFs. I mean, they've been proven that ETFs will outperform most brokers most of the time. So you can get on a free platform like Fidelity or Vanguard and invest there. Now, if you have a different strategy, or if your broker has a different strategy that you really feel is doing really well and you want to pay them, then pay them. You should have a purpose to the payment. Right. If you're getting what you want for that fee, then yes, definitely pay the fee.
Just ask why. Why am I paying this fee? First of all, how much am I paying? You need to identify how much you're paying, just like you identify how much risk you're taking, what you have what you stand to lose. Ask why. Why am I doing this? And if the answer is because XYZ and it's a logical answer, this is something that you cannot achieve otherwise, then great, go for it. Pay the fee.
So Daniel, how do I find out what my risk, fees, and taxes are?
Well, go to our website, riskfeestaxes.com.
And we do an analysis, right? We do analysis for only $500. It's discounted for anybody that's listening to this show. You get,
but it's a free call. So first of all, you meet with us. There's no cost to meet with us. And then we can talk about getting you your analysis, and it's a very discounted price to do a risk, fee, and tax analysis. And then we'll do that Zoom call and share with you how to reduce your risk, fees, and taxes, and then give you an income plan to maximize the income you can have in retirement, and
show you the math behind it so you have confidence in your plan.
Yes, but it doesn't cost anything to go to our website, get a free call, schedule a Zoom call with us, and we'll give you fiduciary advice specific for you.